Okay, let's dive right into this explainer. Today, we're going to uncover the invisible financial engine that is literally powering India's economy. When we think of finance, we usually picture massive bank branches, long lines, and tons of complex bureaucracy. But running silently in the background, and honestly sometimes right in front of our faces, is a totally different architecture. We're exploring the fascinating world of non-banking financial companies, or NBFCs for short. Now, to really get why this matters, we have to start with a huge question. Who actually funds the unbanked when traditional banks just say no? Imagine a small business owner out in a rural village or a middle-class family trying to buy their very first two-wheeler. Traditional banks are massive and, let's face it, they move pretty slowly. Their strict rules often just shut out everyday consumers. So who steps in to offer quick, accessible loans? Well, that is exactly the gap this alternative financial architecture fills. To demystify this whole ecosystem, we've got a really clear plan. First, we'll look at the invisible financial engine. Then, banks versus NBFCs. Third, the types of NBFCs. Fourth, the RBI's regulatory safety net. And finally, how they are fueling the economy. Let's jump in. Part 1, the invisible financial engine. Let's figure out exactly what this crucial piece of financial machinery actually is. So, what is an NBFC? At its core, it's a financial institution registered under the Companies Act. They provide banking and financial services, but here is the absolute kicker. They do it without holding a formal banking license. They're regulated by the Reserve Bank of India, but because they don't have that traditional banking license, their day-to-day looks a bit different. They basically focus on giving out loans, advances, credit facilities, leasing, and making investments in stocks and bonds. You probably already know some of the major players. We're talking about heavyweights like Bajaj Finance, Tata Capital, Shriram Finance, HDB Financial Services, and Muthoot Finance. Think about it. When you walk into an electronics store and get an instant 0% EMI loan on a brand new TV, or when you pledge gold for an emergency loan, you're almost certainly dealing with one of these massive companies. They act as this highly visible alternative bridge to getting credit. But how does the government decide who is an actual NBFC and who's just a regular company doing a little investing on the side? Well, they use something called the 50-50 test. It's pretty straightforward. To be legally classified and regulated as an NBFC, over half, so more than 50% of a company's total assets must be financial assets. And on top of that, over 50% of its gross income has to come from those financial assets. If a company hits both of those markers, boom, the RBI says your principal business is finance and you have to play by NBFC rules. Moving right along to Section 2, banks versus NBFCs. Now that we know what they are, let's see how these agile companies stack up against traditional banking giants. When we look at them side by side, their operational DNA is fundamentally different. Like we just talked about, banks require a banking license and NBFCs don't. But crucially, and this is super important, NBFCs are not part of the country's payment and settlement system. That means they sit entirely outside the core plumbing of the financial network that traditional banks use to move money around instantly. They might lend money just like banks, but their underlying infrastructure operates by a completely different set of rules. Because of that different DNA, there are some really strict limits on what they can actually do. To put it in plain English, NBFCs cannot take your everyday savings or checking accounts. The industry calls those demand deposits because, you might demand those funds back at any second. They also can't issue checkbooks drawn on themselves. And perhaps the most vital thing for you to know as a consumer, any deposits you do place with an NBFC are not covered by the DICGC. That's the government deposit insurance that protects your money if a traditional bank goes under. With NBFCs, that specific safety net just does not exist. Because they can't operate like traditional banks, they've evolved into highly specialized entities. This brings us to Section 3, the types of NBFCs. At the most foundational level, the whole ecosystem is split into two massive categories based on liability. On one side, we have deposit-taking NBFCs. Even though they can't take daily savings accounts, they are legally allowed to accept fixed-term public deposits. And on the flip side, we have non-deposit-taking NBFCs. These guys rely entirely on their own capital, market borrowing, or bank loans to fund their operations. They simply do not accept public deposits at all. From there, things get even more categorized based on activity. You see, traditional banks are kind of generalists. They do a bit of everything. But NBFCs, they are hyper-specialized. We've got asset finance companies funding heavy machinery and autos, microfinance institutions empowering folks with tiny loans, plus housing and infrastructure finance companies that fund everything from your family home right up to massive national highways. And the regulations strictly enforce this specialization. For example, to be an infrastructure finance company, an NBFC must deploy a massive 75% of its total assets specifically into infrastructure loans. They can't just suddenly pivot to funding consumer electronics. This ensures that dedicated pools of capital stay laser-focused on building the nation's critical infrastructure. So if they're moving massive amounts of money without a traditional banking license, how are they kept safe? That's Section 4. The RBI's regulatory safety net. To manage this whole complex ecosystem without totally stifling its agility, the Reserve Bank of India uses a brilliantly designed framework called scale-based regulation. It's essentially an escalating four-layer system: base, middle, upper, and top. Think of it as a safety net that scales up right along with the size and the risk of the company. A tiny peer-to-peer lending startup in the base layer gets lighter rules, giving it room to breathe and grow, while massive financial giants face intense, bank-like scrutiny. What's really fascinating here is how strictly the RBI reacts to public risk. The middle layer automatically captures any NBFC that accepts public deposits, no matter how small they are. Because they hold public money, the scrutiny instantly goes up. And for the ones that don't take deposits, hitting the 1,000 crore rupee asset mark immediately bumps you up into this highly regulated middle layer. It's a hard boundary to make sure large entities don't just fly under the radar. As we move up the pyramid, the upper layer handles the systemically important entities. But that top layer, that is explicitly reserved for NBFCs representing extreme systemic risks. And thankfully, the RBI's proactive management means this layer currently remains mostly empty. It really exists as an emergency classification for a true crisis scenario. It shows just how deeply the RBI thinks about preventing financial contagion before it even has a chance to happen. All right, let's zoom out from the regulations and look at the really big picture. Section 5, fueling the economy. NBFCs are the ultimate engine for financial inclusion, period. While a massive bank might take literally weeks to process a loan for a small business in a Tier 3 city, an NBFC utilizes technology and deep local knowledge to move at lightning speed. They offer vastly faster loan processing and personalized financial products. They're directing vital credit to heavily underserved sectors, specifically rural areas and MSMEs, which are truly the backbone of the economy. There's a quote that perfectly hits the nail on the head. NBFCs are critical for financial inclusion where traditional banks have limited reach. Ultimately, that is their true superpower. They step in to build a bridge exactly where traditional banks stop. They have the flexibility, the targeted expertise, and the specialized regulatory framework that allows them to take calculated risks that rigid, traditional banks just can't afford to take. As these agile NBFCs use advanced AI and digital public infrastructure to bridge the credit gap faster than ever before, we have to ask ourselves a pretty big question. Will the line between traditional banks and this invisible engine eventually disappear entirely? Or will NBFCs just become the new standard for credit altogether? It's a totally thrilling space to watch. Thanks for joining me for this explainer, and keep questioning how the invisible machinery around you really works.